Caught in the middle, markets face some encouraging news on the economic front, some troubling news about the virus, and look for news about further government help. This is Bloomberg Wall Street Week. I'm David Westin. This week, Senator Rick Scott of Florida.
As I talk to Floridians, I think everybody realizes now the risk of coronavirus, but we also know we have to open our economy.
Contributor Larry Summers of Harvard.
I think the Fed has fired most of the ammunition it has. We could have new problems.
Ed Bastian of Delta Airlines.
If we're able to get through this pandemic without any furloughs, we're a different airline at that point.
Contributor Stephanie Flanders.
If you get it right, you can have that V-shaped recovery that so many investors are betting on.
Ralph Schlosstein of Evercore.
I do think that the confidence provided by the Fed has allowed more normalized markets to return.
And Liz Ann Sonders of Charles Schwab.
I don't think we're going to quite get fear back. I think we may need a little bit more to sort of reverse that sentiment environment.
This week was a confusing one for global Wall Street, with economic numbers like retail sales indicating maybe we've bottomed out or maybe even on our way back up, although Fed Chair Jay Powell said we still have a ways to go.
The levels of output and employment remain far below their pre-pandemic levels, and significant uncertainty remains about the timing and strength of the recovery. Much of that uncertainty comes from uncertainty about the path of the disease and the effects of measures to contain it. Until the public is confident that this disease is contained, a full recovery is unlikely.
And the thing that brought us all here, the COVID-19 virus, showed some indications it may be coming back in places like Florida and Texas and Arizona and even over in China, where it all began.
You're now seeing some hotspots potentially in Houston, Phoenix, parts of Florida. You can't let this get out of control because then contact tracing goes out the window. And that's when you really put pressure on the hospital system as a whole.
Leaving markets, businesses, and consumers to figure out when we'll return to some form of normal and what form that normal may take. All of which meant that the markets moved a fair amount this week, but not in any particular direction. Here to help us find that direction is Liz Ann Sonders. She's Chief Investment Strategist at Charles Schwab. Liz Ann is no stranger to Wall Street Week. She appeared back in 2001 when it was the days of Louis Rukeyser.
There's a mistake being made now, and it's actually very similar to a mistake that was made a year ago, which is the assumption that the conditions of a year ago were permanent. Strong economy, aggressive spending on technology, but as it typically does, the psychological pendulum swung completely in the opposite direction. And I think the view that really is pervasive now of slow growth economy and no spending on tech and the fact that that's permanent, that's not the right answer either. It's probably somewhere in between.
Well, that was then, and this is now, and we're delighted to welcome Liz Ann Sonders now back to the program. She's Chief Investment Strategist at Charles Schwab. So welcome back. It's great to have you, Liz Ann. So help us a little bit understand these markets. As I say, there seemed to be a lot of movement, a lot of heat and life, but in the ultimately, it didn't really head in any particular direction, did it?
No, and I think we're in a phase now since we had that very brief pullback last week or the week before. It all blends these days. I think we're probably in a near-term choppy pattern. There's no question that the top of mind for investors, at least those clients with whom I'm interacting, of course, all in a virtual fashion, the number one question is about the perceived disconnect between the market and the economic data. Now, more recently, of course, we've gotten this improvement in the economic data, but I think we have to be really careful about extrapolating that. The nature of this shutdown is such that we're dealing with the law of really, really small numbers. When you compress economic data to such a significant degree, the math is such that the percentage increases off those bottoms is going to look huge. I think the reality is probably more rolling W's as we look out over the next several months. And remember, the left half of a W, of course, is a V. I'm a big believer that rate of change is extremely important. Inflection points are important. But in this case, I think level is important too. I mean, you look at retail sales, a huge bounce, but we're still 40% below where we were. So I think we have to look at the combination of level and rate of change, especially in this environment.
Well, as you say, Liz Ann, even with retail sales were 17% better than they thought, they still are well over year. And then you look at unemployment, well, the claims are coming down, but pretty slowly. There's still over 20 million continuing claims there. So really, how can the market, which is supposed to be discounting future earnings of corporations, say those corporations are going to be earning that much money given what's going on around us?
This is I think, a very classic example of don't fight the Fed. I grew up in this business from 1986 to 1999, working for the late, great Marty Zweig, who coined the phrase, don't fight the Fed. And I think the power of what they have done in this cycle has been seen not just in the equity market, but the calming of credit spreads, which came just with the announcements of some of their relatively new facilities. They didn't even need to be put in place. I think you add to that the relief package, the income support by Congress. We've never seen anything this massive. The combined, you can't really call it stimulus, the combined liquidity and relief equates to more than 25% of GDP. That is extraordinary. And for now, that has been the support. We've had this chasm representing the compression in economic activity, but they've just been pouring money into that to try to bridge us from what was to whatever the post-pandemic norm looks like. So that's the primary reason. And then FOMO, it's momentum driven to a large degree too. So that feeds on itself.
Liz Ann, to oversimplify, is this all good news for investors or bad news? It's good news in the sense that asset prices are being driven up by a lot of money being pumped into the system. On the other hand, are we losing the ability to distinguish good investments from bad investments according to price?
That is, I think, one of the, I suppose, unintended consequences of what the Fed has done. And I don't want to second guess whether we would have been better off had the Fed not taken these extraordinary steps. But there's no question that we do, I'll use a technical term here, muck up the sort of natural price discovery. And I think that not only is a concern in this environment, quite frankly, is a concern that emanated out of the financial crisis as well. So I think we're sort of feeding on those concerns, and that does bother me. Of course, it also contributes to the wealth gap, because when you see lack of inflation in the real economy, but you see massive inflation in asset prices, obviously those on the wealthier end of the spectrum are the holders of those assets. So I think we are breeding some of what came out of the financial crisis as well, and that is not going away anytime soon.
And what about the role of COVID-19, which brought us to this place to begin with? To what extent are the markets reacting to that? We thought this week, maybe we saw rotations going back and forth depending on whether you wanted a stay-at-home stock like some of the big tech, or whether you really wanted to go into cyclicals and things you're thinking about. There's going to be a real recovery here.
I think the virus news around the virus will continue to be, certainly on a short term, even a day-to-day, biggest driver of markets. When you look at the four major headlines that we got on therapeutics and/or vaccines, I think the two therapeutic announcements were back in April, both on remdesivir, and then you got the two initial big headlines on vaccines. I think the first one was Gilead and the second one was Merck. Those four individual days accounted for almost 2,700 Dow points. Over that span of time, that was more than the Dow had gained the entire period of time. Fast forward to today, you see the news of the increase in virus cases in some of the southern states, and Apple coming out and saying they're closing stores down in Florida, South Carolina, North Carolina, and Arizona. And if you want to sort of find something to point to why the market weakened during the day, I think that was it. So I think there's no question we are still at the mercy in both directions of virus-related news.
And pick up on that Apple news specifically. Is that a potential warning to other companies' investments in other stocks to say, basically, this is not going to be a straight line up? In fact, we may see other closures. If Apple did it, why shouldn't somebody else, as we have increased problems in Florida or Texas, places like that?
Absolutely right, which is part of the reason why my view of what this recovery is going to look like are these rolling Vs, or rolling Ws, I should say. And I think that there was too much enthusiasm about what seems to be governments at the state and local level, at the federal level, saying we're not going to do a wholesale shutdown again, even if we get second waves. But that doesn't mean that business owners themselves, either large multinational corporations like an Apple or smaller mom and pop companies, aren't going to say, you know what, for the safety of our own community, we're going to shut down. So fits and starts in the economy is not just a function of the mandates coming down from government. It's the decisions that businesses make and the decisions that consumers make. And I think that's not been mapped out in sort of investor psyche, at least in the more recent period where there's just so much enthusiasm about the recovery.
Yeah, that seems exactly right. Thank you so much, Liz Ann Sonders. It's always great to have you with us. You heard it there from Liz Ann Sonders, Chief Investment Strategist at Charles Schwab, talking about a choppy market, but you shouldn't fight the Fed, which is something she learned from the legendary Mr. Zweig. Coming up, how the deal makers of global Wall Street are coming to grips with the new world that's emerging. Ralph Schlosstein, head of Evercore, is here.
I don't think until we have greater certainty about the direction of the economy that you'll see any large for cash mergers at this point.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We're facing a self-imposed recession like we've never seen before, which has led the government to intervene in the economy in a way it's never done before, all of which raises questions about how the rules of the game have changed, something we asked Ralph Schlosstein, CEO of Evercore, about.
If you go back about 2.5 months or so, there was absolute illiquidity in the debt markets, short-term and long-term. No company could finance investment grade. The highest quality companies, when they tried to roll over their commercial paper, found it difficult to do so. So we had a real severe liquidity crisis, and the further down the credit spectrum you were, the more severe it was. And the interesting thing about what the Fed did is by being as aggressive as they were, they actually reduced the need for even more aggressive action. The fact that they stepped in and aggressively bought treasuries and mortgage-backed securities initially and broadened the aperture of things that they would be involved in from a support point of view to include private sector businesses, municipalities, Main Street businesses. Certainly the fact that they're there as a buyer of last resort typically ensures that they don't have to use those powers as much as they otherwise would have had to use them.
But Ralph, does there come a point, at some point, where it starts to distort the marketplace, where actually you can't really have price discovery because the thing that's determining the price is not the value of the asset, but actually what we think the Fed might do? Well,
there's certainly an element of watching what the Fed does, and certainly if you're a market maker or a trader, you're not going to want to be on the other side of a trade of an investment that the Fed is making. You wouldn't want to be short things that they're interested in buying. However, I do think that the confidence provided by the Fed has allowed more normalized markets to return and to get a real two-way flow in markets that are just fundamental to the support of our economy. The irony here is this: in this particular crisis, the financial institutions are in as strong a position as they have ever been, and so the Fed supporting the liquidity of the market where financial institutions didn't play themselves provided a really important boost both to the real economy and to the markets.
Does what the Fed is doing, and for that matter, Congress as well, does it affect some of the deals that you might be looking at? As a practical matter, it's driving up all asset prices, right? Without regard almost to the strength underlying of the company. Does it really affect your deal making?
Yeah, well, the hardest transactions to do right now, as you can imagine, are transactions where a significant amount of cash is involved. For example, the transaction that we were involved in last week, the Grubhub Just Eats transaction, that was a stock for stock transaction. So you have to obviously do diligence on both companies' prospects. The buyer has to do that on the seller, and the seller, because its shareholders are taking the buyer's stock, also has to do due diligence. But when you have two securities that have been roughly comparably affected by in this case, the actions of global monetary and fiscal policies, because Just Eats is a European company, it's an easier transaction to get done. I don't think until we have greater certainty about the direction of the economy that you'll see any large for cash mergers at this point.
Do the CEOs you talk to have any sense, any visibility about when we might have that greater certainty about the economy?
Well, I think the real question is going to, we're clearly in the midst of a pretty significant snapback in the economy. I think that my own view, and I think most CEOs' view, is that the damage to the economy is is greater than would be suggested by a sharp V recovery. Somebody described it as what we could have as a check recovery, where we have a steep decline and then it doesn't go up quite as much.
That was Ralph Schlosstein, President and CEO of Evercore. Coming up, the virus gets a vote. We talk with Dr. Stephen Corwin of New York-Presbyterian Hospital about the risk of the virus coming back.
Even with the opening up, one can still maintain social distancing. I think people are weary of that, and therefore we need to be wary of an uptick in infections.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. When the coronavirus hit ground zero in New York, Dr. Stephen Corwin was on the front lines fighting it as CEO of one of the largest and most prestigious hospitals in the country. And he says that as much progress as we've made, we are not out of the woods yet.
At our peak, we were at about 2,700 cases throughout my hospital system. That represented about 80% of our capacity. We're down to less than 350 cases now in our institutions, and much less in terms of ICU care. So we clearly have been on the downward trend, and thankfully that's continued and taken off some of the pressure on our system.
So the next stage has to be, how worried are we about an uptick? We're seeing it in some of the states, not big numbers, but the rate is disturbing. We also now see it in Beijing as well. How concerned are you that here in New York we could have an uptick?
Well, I'm concerned across the country that we're going to have an uptick. You're now seeing some hotspots potentially in Houston, Phoenix, parts of Florida. You can't let this get out of control, because then contact tracing goes out the window, and that's when you really put pressure on the hospital system as a whole. I'm concerned about people becoming weary about social distancing. Even with the opening up, one can still maintain social distancing. I think people are weary of that, and therefore we need to be wary of an uptick in infections and follow that closely. In the other areas of the country, you need to follow not just the increase in infections, because if you test more, you're going to find more people have it, but what's the hospitalization rate? And that's where I get concerned in speaking to colleagues in Houston and Phoenix, David.
And so are we better prepared for an uptick at this point from things we've learned about the virus and how to treat it? And for that matter, on some of the equipment issues like ventilators and personal protective equipment, are we better prepared for an uptick when it comes?
No question about it. We're better prepared. We could deal with the second wave more effectively, both from the standpoint of state and city government, as well as how hospitals need to prepare for it. We know how to surge. We've changed the way that we look at how much protective equipment we need, how many ventilators we need, how much ICU capacity we need. So I think we're better prepared for it, but let's just remember, we still are only talking about supportive therapy. We don't have an effective therapy. We don't have an effective vaccine. And so keeping the transmission rate less than 1 is how you don't overwhelm the economy or the hospital system.
And as a practical matter, what is the likelihood of an effective treatment or a vaccine? There's a lot of talk about it even by the end of the year. It's impossible to know for sure, but what do you think about the prospects?
You know, we should all be rooting for it. There's no question about it. I think it's more likely that we will start to see effective combination therapies before the end of the year than we will see an effective vaccine, but we hope for both. If past as prelude, the earliest development of a vaccine took about 4 years, and that's the Mumps Vaccine. So I would be dubious to think that we could get mass inoculations in 20 or 21.
That was Dr. Stephen Corwin of New York-Presbyterian Hospital. Even as New York was getting ahead of the virus, other states that opened up sooner were having growing problems. That includes Florida, which reported the most cases of COVID-19 since last April. We talked to Senator Rick Scott, and he said that the state is now taking it very seriously.
As I talk to Floridians, I think everybody realizes now the risk of coronavirus, but we also know we have to open our economy. So our businesses are saying, how do we keep our employees safe? How do we get our customers back and keep them safe? And I think all of our families are saying, how do we get back to a normal life as quickly as we can, but knowing we have to do it safely? I know we're doing a lot more testing right now. I know that we're working on the vaccine. I know our doctors are working on, and our pharmaceutical companies are in the therapeutics. So I think it's all hands on board, but we got to keep our economy open and keep people safe.
What does that tell you, if anything, about the need for further fiscal stimulus, and when would we have it?
Well, first off, I think we have to be careful about how we spend our money. This is somebody's taxpayer money. It's either you're taxing people now or you're going to tax them later. So let's focus on the biggest problem. Let's make sure we have liability support, we protection for our first responders and our small businesses. Let's make sure we help those that have lost their jobs. Let's make sure we help our small businesses. But what I don't want to do is fix the budgets for states that have wasted their money for years. They won't balance their budget. They just keep borrowing money, won't fix their pension plans. And like Florida taxpayers shouldn't be paying for that. So we've already spent a significant amount of money at our states. Let's make sure we get a return on all the money we've been spending, and let's help those that are still unemployed and help our small businesses.
Senator Scott, does that give you a different attitude perhaps toward an infrastructure bill? Because there are stories now that the White House may be considering a $1 trillion proposal. Do you see that more as an investment that you would get return on? Would you be in favor of that?
Well, I did it as governor. I believe in investing in our infrastructure. I took our transportation budget from about $7 billion a year to $10 billion a year. We invested $1.5 billion in our ports, and it paid off. So as long as you invest your infrastructure dollars in areas where you help create jobs, it works. What I said to our transportation department is, let's spend our money where we're going to get more jobs. And it helped us because in those 8 years, the private sector had 1.7 million jobs in my state. So I believe in our infrastructure. I believe in investing in the infrastructure, but we've got to do it in a manner not just to feel like, oh, we spent some money, but we actually help our job market. That's what we need, more jobs in this country.
That was Republican Senator Rick Scott of Florida. Coming up, airlines come to grips with a very different world and how they can manage a turnaround. We talk with the CEO of Delta Airlines, Ed Bastian.
I would imagine by the spring next year, be at a point where we're break even. And I also think that's the time when people will have more and more confidence being out in public.
This is Wall Street Week on Bloomberg. Consumers are starting to shop and spend again as economies cautiously reopen. But the road to recovery for the travel industry could be long.
It matters whether or not there is consumer demand for those unstructured activities, things that you do by choice. It's going to be L-shaped for them.
The travel industry accounts for 10% of the global economy and employs around 300 million people. The International Air Transport Association estimates that airlines will lose a combined $84 billion this year and almost $16 billion in 2021, more than 3 times the loss during the 2008-2009 recession.
The main obstacle now that we see for the to restart the air transport industry are the restrictions that are put by governments on flights, on or border closures or quarantine measures.
The supply side of the equation remains under pressure because of concerns over a second wave of infections.
One should also bear in mind that the capacity and the supply is clearly far, far less than you would expect as well.
Globally, ticket prices are down about 14% this month. The U.S. and Asia are expected to see an upswing in prices next month, according to data provider Skytra. In the U.S., domestic travel is helping ease some pain for carriers.
We are seeing a pent-up demand for leisure travel, but we're also seeing customers going back and seeing their family and friends.
Even as personal travel climbs back, corporate trips could stay grounded for some time.
I think corporate travel will bounce back, but probably take longer than consumer travel, and that's why we're predicting a return to 2019 levels of overall travel bookings, not until 2023 at the earliest.
Federal stimulus money is doing its part to keep airlines afloat. U.S. airlines got $25 billion under the CARES Act, but that money runs out in a matter of months.
After September 30th, when the CARES Act payroll dollars cease, we're looking at what the size and shape of JetBlue will look like. We're obviously going to be a smaller airline.
Airlines have been particularly hard hit by the pandemic, but this week they started planning their comeback, albeit with some changes in how we fly and how their businesses will work. We talked with the CEO of Delta Airlines, Ed Bastian.
We're in a process of a recovery, no question about it. It's slow. It's going to take some time, but there's clear signs. The momentum we have is meaningful, and it's continuing to build. We bottomed out in mid-April with maybe only 5% of our normal customer load traveling today. That number is closer to 15%. So the optimist in me says we've tripled over the last couple months, which isn't bad, but we got a long ways to go yet. I expect that number to get up to 20% in the coming weeks. We're adding a bunch more flying, both in July and again in August. 1,000 flights a day each month added in the next couple months. And so by the end of the third quarter here, we hopefully are back to about 30% of our loads that we are carrying. So we're being very disciplined, taking good care of our people and customers on the journey, but the recovery has started.
So how much visibility do you feel you have beyond that third quarter? I mean, if you go up to 30%, does it keep rising at a fairly steady pace, or is there a possibility of plateau? What do you anticipate going forward? When will you be back to essentially full usage?
Well, there's never been more uncertainty given what we're addressing with both the pandemic and the resultant economic impact. Changes in business travel patterns will also impact this industry. So our crystal ball is a little murkier than normal. But I do expect after Labor Day, it's going to be an important milestone and pivot point for us, because that's typically when business travel starts to pick up again. Right now, the vast majority of our customer base is leisure. People going out, there's some good bargains, not just in the air, but on the ground as hotels and theme parks and casinos are all opening. But we need businesses to start opening. And right now, most businesses are still largely closed, big corporate businesses. And as they start to open, hopefully after Labor Day, you'll start to see an improved mix of revenue flow, and that then will be the next stage of the recovery for us.
A key element for all businesses seeking to reopen is the confidence of customers, that they will be safe when they go to the business. What are you doing at Delta? Give us a sense of what the sort of operational changes you're making to try to reassure travelers that they will be okay on your aircraft.
We've put distancing protocols in place. We've capped load factors. On Delta, we will not board planes more than 60% full, which guarantees the seat next to you, every seat next to you, is open on board the plane. There's no middle seats being sold at all. We've put electrostatic fogging in place before every single flight that takes off.
All of which must be very encouraging to people using Delta Airlines. At the same time, is there a trade-off here? You mentioned load factor, 60% load factor. That historically has been an indicator of profitability for airlines. It has always been sort of a tough business to be in the airline business. Can you get a good business with reduced load factors as a practical matter? Doesn't that really hit your profitability?
Well, the steps that we're taking are certainly temporary. Once there is a vaccine, once there are therapeutics to deal with the virus, once there's herd immunity, whatever combination of factors get involved with respect to society feeling safe to be out in public once again, obviously we'll start to increase the load factor caps and eventually take the caps off. But for now, while there's still public concern, I want to instill confidence in the travel experience and give customers the assurance that when you book on Delta, you will have space on board, you'll have that seat next to you open. And when we get up to close to 60%, because right now we're about 50% full, so in some markets we're already bumping against the cap, that's the key to add more flights, add bigger planes back into the system. And then eventually, as confidence is restored, you'll see more traveling at scale over the next 12 to 24 months. I would imagine by the spring next year, be at a point where we're break even. And I also think that's the time when people will have more and more confidence being out in public, more accustomed to the safety protocols, and word of mouth from consumers as they get out and they travel and they see it's actually not as scary as people think.
At Delta Airlines, with other airlines, took some money from the government. As part of that, agreed that they would keep employees on at least through September. Should we expect a substantial outflow employees from Delta come September?
I don't think so. We're about protecting people here at Delta, protecting our customers, protecting our own people. We're working really hard to eliminate the need to furlough. I can't guarantee that. We don't know what the shape of demand will be in the fall, whether there will be a return of the virus, a second phase or wave, as it's referred to. But I can tell you that the people at Delta are doing a really good job of job sharing. We've got voluntary time off. Currently, almost 40,000 of our people, which is close to half our workforce, are out on voluntary leave, anywhere from 30 to 120 days, which is really helping the airlines save a lot of costs. If we're able to get through this pandemic without any furloughs, we're a different airline at that point.
That was Ed Bastian, CEO of Delta Airlines. Coming up, the Bank of England was the latest central bank to weigh in on what needs to be done for the economy, stepping up its bond buying program by £100 billion. Our contributor, Stephanie Flanders, on what the BOE decision means.
I think policymakers, both on the government side and on the Bank of England side, are factoring that into their considerations. They don't want to commit themselves before they really see what the scope of the damage is.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. England has its own version of economic problems, triggered by its response to the pandemic, layered on top of the uncertainty surrounding its leaving the European Union. This week, the Bank of England took steps to shore up the British economy by increasing its bond buying program, although it stopped short of taking steps toward a negative interest rate. We talked to Stephanie Flanders. She's Senior Executive Editor for Economics at Bloomberg and also a Wall Street Week contributor. And Stephanie said that the Bank of England had some surprises for us this week.
The surprise for the markets was that they were suggesting that they might sort of taper off the bond buying by the end of the year, at least in terms of their formal plans. They're saying they think it could end at the end of the year. I'm not sure that we really believe that they won't buy more at that point, but it does speak to the uncertainty they see. Remember, the UK has really not got very far along lifting the restrictions on the economy. We're well behind continental Europe on that. So the uncertainty about what this crisis is going to leave behind, let alone worries about second wave and other things, is really great. And I think policymakers, both on the government side and on the Bank of England side, are factoring that into their considerations. They don't want to commit themselves before they really see what the scope of the damage is.
So as you say, Stephanie, you've got the COVID-19 issues, and those are devilishly difficult, as we've proven here in the United States. You also have that little thing called Brexit that's hanging out there. What will buying more bonds, £100 billion more bonds, what will that do for the economy in the UK?
Look, it's the same question that you raise is everywhere, but as you notice that there's a lot more going on in the UK. Even the government's not been very effective in dealing with the public health crisis, although the measures to support the economy have been effective. We've had this prolonged shutdown, which may mean we have the biggest decline in GDP of all the major economies. So to add to that, the decision to just move out of very long-term, 40-year relationship with the European Union, obviously on the outside looks a little crazy. But I guess the positive spin on it is that whatever cost that one sees associated with Brexit, whether it's a few percentage of GDP, that seemed like much bigger number a year ago than when we started seeing these big numbers related to the shock of the COVID crisis. So I can't help thinking that's what ministers are thinking. We just need to get Brexit over with, because any negative effects will be kind of lost in this emergency over COVID.
So how do you put together, on the one hand, the economic side, some of the stimulus being given, monetary and coming fiscal, with how you're handling COVID-19? It's hard for all of us to sort out right now how much of this is the economy, how much of this is consumer confidence as people can come back into the marketplace.
I think is a really striking lesson, especially when you look at the data coming from Germany and France, as the fear of the virus and fear of getting infected. They actually have a measure of that they've been polling people for 6 months or more or a few months in Germany. As that fear goes down, you've seen consumers go back. I talked to my colleagues in Germany, a German economist. Their families are going out, eating pizza, going back to swimming pools. It's starting to feel normal in only a few weeks. And I think that's because there's confidence in the strategy, confidence that the government has got the disease under control. Where you have in the US, some states where cases are going up, or Sweden, for example, where they never had big lockdown requirements, but people had been worried about going out, you may see a much slower pace of recovery. But it's a really good example. If you get it right, you can have that V-shaped recovery that so many investors are betting on.
That was Wall Street Week contributor Stephanie Flanders. Coming up, we wrap up the week with our special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. To help us pull together the strands from this week on Global Wall Street, welcome now our special contributor, Larry Summers of Harvard. So Larry, normally we take a sort of macro look at what's happened. This week, let's take a look. You suggested it. It's sort of micro. Let's go sector by sector. Take 2 or 3 sectors. Start with airlines. We just heard on this program from Ed Bastian, the CEO of Delta, that they are on their way back. It's going to take a little while, but they're really on their back. And stocks, by the way, airline stocks came up this week as there were reports of more bookings. What are we learning about the economy and the markets from what's going on with the airlines?
Well, I'm surprised at what's happened to the total value of airlines. If you look at their equity plus the value of their debt, it's remarkably close to where it had been before COVID. I wonder whether the market's a little ahead of itself with respect to the airlines. I think there are a number of stocks. Hertz was another one as it was going through bankruptcy that retail have been piling into as a kind of bet that this crisis is going to resolve itself fairly quickly. I think airlines will work themselves out of this some which way. They will cut costs. They will cut the number of flights they are running. They will probably jack up prices to cover the costs of lower occupancy factors. But I suspect it's going to be a difficult period ahead for the airline industry. And I think that the world has changed because of what technology is making possible. And there are going to be many fewer road warriors in American business than there ever have been before. And that's going to take a lasting toll on airline bookings. Right. So I kind of think this is a microcosm of an issue that we have generally in the economy, that markets may be getting a little ahead of some genuinely favorable news that we are turning back. But in some areas, I think markets are probably a bit ahead of reality.
So that's the airline industry. Let's talk about digital right now, technology in particular. That technology really has been on a tear for some time now. The COVID-19 has not slowed it down much at all. At the same time, there is this issue about digital taxation as countries around the world are saying, we want to tax some of what you're doing right now. We thought we were negotiating an international deal about how we're going to have digital services taxes, and then the U.S. actually pulled out. Steve Mnuchin, the Treasury Secretary, pulled out. The Europeans didn't take it well. They said it was a very provocative act. They're going to go their own way. What might this mean for the future of digital and technology?
Well, let's separate two issues. This is a good time for technology companies. The fact that we're all working out of our homes, the fact that we're all doing our shopping out of our homes, the fact that we're all having our social interactions out of our homes, the platform companies that enable all of that, this is a terrific opportunity. They are rapidly growing companies that have secure cash flows well into the future in an era when interest rates have come way down. So they're long duration companies, to put it in financial parlance, and that's also contributed to the strength of their stocks. So it's a good time to be a big technology platform company. It's a time when they're earning more rents than they ever have before. There was an important, very substantial issue of their undertaxation before. The nature of their business made it very difficult to trace their income to any individual country. And therefore, they were able to locate income in tax havens, in some of the lowest tax countries in the world, or they were able to locate income in cyberspace where it wasn't deemed to be part of any country. And therefore, on a global basis, those companies have paid remarkably little in taxes relative to their market value. It's actually been at the edge of abusive for some years. It was exactly the right kind of thing that globalization negotiation should be about, to try to take on that problem and to have a global cooperative regime so that we could tax the profits of these extraordinarily fortunate companies and their stockholders. I don't know what exactly the right position is on the details of the negotiation. And I recognize that there is some risk of a gang up on America aspect in this, because most of the companies that have this tremendous platform capacity are American. Think of Amazon or Google or Facebook or Microsoft, Apple. But God, the job of the Secretary of the Treasury is to be standing up for 330 million American citizens, not 10 American tech companies that pay less taxes than the secretaries who work within them pay as a share of income. And so to see the United States adding this negotiation over global tax fairness to the list of negotiations it's torpedoed in recent years, I really wasn't happy to see that. And I think that the Secretary of the Treasury should be looking to be as constructive as he can with respect to a very difficult problem, not to be doing battle for the economic interests of trillion-dollar companies that between them don't employ 1% of the American people.
And finally, Larry, let's take a sector near and dear to your heart. That's higher education. You not only are a professor at Harvard, you ran Harvard for a time, and of course you know higher education very, very well. How is higher education in the United States going to come out of this pandemic? Because there's a lot of uncertainty about kids going back to school come September.
So the issue everybody's excited about is what's going to happen in September. And the truth is, nobody knows. Everybody's watching everybody else. And they've got to be very careful, because if you think about it, a college dorm is a lot like a cruise ship. People who are in close quarters, people who are often inebriated, people who are looking for companionship, shall we say. And cruise ships are hotbeds of contagion, and college dorms may be as well. And the first obligation of any university president is to make sure that her university isn't a major source of contagion to the community. So I think they've got to be very careful, even as important as it is, with respect to bringing kids back. But really, the question is this moment going to be the catalyst for major structural reform in higher education that emphasizes the capacity of technology to cause materials to reach a very large scale, rather than calculus being taught 5,000 times every fall semester in 5,000 different high schools and colleges? Are we going to figure out to use technology to bring the best performances of instruction to the most people, use technology to permit personalization where you receive input at a rate that depends on your own ability to absorb it, which is being measured continuously with little quizzes, use technology to enable customization and tailoring of intellectual materials to the individual student. What should be happening is universities should be stretching and competing to be the leader. I'm not sure, frankly, that universities have the courage to be so dynamic.
And we're going to find out. That's the world according to Larry Summers, which is the world we always want to see right here on Wall Street Week. You heard about it from him, about the higher education as well as digital, as well as aviation. It's been an eventful week, a lot of ups and downs with not a lot of direction in the markets. But Larry Summers took us through those three critical sectors. So thank you very much, Larry Summers. Finally, buddy, can you spare a dime or a nickel or a quarter? We learned this week from Fed Chair Jay Powell that it's not just jobs and corporate profits we're running short of, we're running short of coins.
What's happened is that with the partial closure of the economy, the flow of coins through the economy has it's kind of stopped.
It turns out that despite all the talk about cryptocurrencies and electronic payments, when things get rough, we all want to hold on to cold, hard cash, which has meant that banks are depositing 50% less coins with the Fed this year than last year. And it's not just coins that we're all hoarding, it's also bills. The amount of bills in circulation has gone up by 50% in the period February to May over a year ago. So if we want some indication of how confident we all are in the future, we might just want to start counting our pennies. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.